Welcome back to Alpha Recap. Markets closed after a busy trading day, and we've got a lot to unpack. Big mergers, AI spending, and an energy market that signaled tightening supplies. As always, if you have questions, you can reach us at stockalpha.ai and ask directly. Joining me is Jessica. Thanks for being here.
Thanks for having me. Excited to dig in.
So, big picture first. How would you sum up the tape?
It really felt deal-driven. There were scale transactions, big capital commitments tied to AI and data centers, and energy signals that pointed toward tighter crude markets. That combination drove selective upside in some areas, while regulatory and idiosyncratic shocks created pressure elsewhere.
Okay, let's unpack that. First up, the apartment REIT merger story. That was the marquee headline today.
Right. Two large apartment real estate investment trusts agreed to an all-stock merger of equals, creating a pro forma company worth about $52 billion. It was a clear example of consolidation in real estate. Scale is the strategic response to higher Capex needs, like energy retrofits and EV charging.
So, in plain terms, why does scale matter for an apartment REIT?
Scale helps in a few ways. Larger platforms can centralize leasing, standardize renovations, and negotiate financing more efficiently. They can also better absorb the cost of retrofits and large capital projects. It doesn't guarantee success. Integration and execution risk remain, but it changes the economics.
Big move.
Exactly.
Let's pivot to technology and AI. There were some headline fundraises and big corporate Capex notes.
Yes. Notably, a startup in the AI infrastructure space raised about $355 million. Meanwhile, chipmakers and cloud providers continued to outline large Capex plans, and one major cloud customer pledged about $15 billion for data center spend. Those commitments are the connective tissue between AI software and the physical infrastructure that runs it.
And why does that matter beyond the obvious? Like saying data centers need power?
Good question. When Capex becomes multi-sector, when hyperscalers, chip makers, and enterprise IT all spend, a wider set of companies can benefit. Semiconductor suppliers, data center real estate, utilities, and construction contractors. Analysts note that this dynamic expands the beneficiary set beyond pure tech names.
Right. And the other thing is
that corporate Capex tends to be multi-year, so the demand profile can be durable. But there are trade-offs. Near-term margins may be pressured as companies reallocate resources toward infrastructure.
Quick reaction. Surprised by that fundraising size?
Honestly, I was a bit surprised by this one. $355 million signals strong investor appetite for specialized AI tooling and efficiency plays.
Switching gears to energy. Traders priced the crude strip higher for next year, right?
Yes, forward markets and trader commentary were consistent with tighter balances. Prices were pricing in about $81 a barrel for next year. At the same time, renewables were gaining share. In some regions, wind and solar generation topped natural gas last month, and storage installs hit record levels. So you had tighter oil fundamentals and accelerating energy transition activity at the same time.
That sounds almost contradictory. Tighter oil, but more renewables?
It's actually complementary. Tighter crude supports upstream cash flows and can boost drilling and service activity. Meanwhile, as renewables take more of the electricity mix, grids need more storage and transmission upgrades. So you get near-term commodity strength and structurally higher Capex for grid modernization.
Which sectors reacted well today?
Technology was an outperformer on AI deals and Capex momentum. Utilities and clean energy saw constructive headlines thanks to record storage installs and large corporate power commitments. And parts of real estate, especially logistics and select multifamily subsectors tied to scale deals, outperformed.
And underperformers?
Cannabis was pressured by a mix of federal-level moves that helped operationally, but state-level vetoes that slowed expansion. Communications and media were under pressure because of regulatory scrutiny around large tie-ups. Crypto was mixed. Some infrastructure gains, but a token collapse and enforcement headlines kept sentiment muted.
Not a great day for some of those sectors.
Yeah, that tracks.
Let's dig into the media consolidation friction you mentioned. There was a big reported deal under scrutiny.
Right. Reported pressure around a deal valued at about $111 billion highlighted persistent regulatory headwinds in communications and media. Large mergers face antitrust and political scrutiny, which can delay synergies or change deal economics. When regulators get involved, outcomes tend to be jurisdiction-specific and timeline-driven.
Short reactions.
Hold on, say that again?
Big deal, long review.
Exactly. Big deal, long review.
We touched on cannabis earlier. Can you summarize that patchwork of policy headlines?
Sure. There were two competing themes. On one hand, federal reclassification opened narrow operational corridors, for example, allowing medical cannabis on flights in specific circumstances, which reduces some friction for operators. On the other, state-level vetoes and regulatory uncertainty limited recreational rollouts in other places. The net effect is that progress exists, but it's uneven and highly jurisdiction-dependent.
So outcomes will cluster by state and federal action, not by broad macro trends.
Correct. When regulation is a dominant driver, results vary by jurisdiction.
Okay, crypto. Mixtape, you said. Walk me through that.
There were headline losses from a token collapse and episodic sell-offs, but also progress on TradFi access and infrastructure proposals. So infrastructure and custody solutions are improving, which is constructive for institutional adoption. But enforcement actions and idiosyncratic failures kept volatility and risk premia elevated.
And finance more broadly. Any notable moves?
Fixed income managers were reportedly shifting toward shorter duration, which suggests concern about rate volatility. Private capital activity included some large supplier raises. Example, a major aerospace supplier raising about $300 million, pointing to selective strength amid cautious positioning.
Right, so positioning matters. Let's do a quick Q&A style rapid rundown. What are the cross-sector themes investors should watch?
5 quick themes. 1. AI and cloud Capex is a lodestar. It's showing up across sectors. 2. Scale and consolidation are reshaping real estate and media. 3. Energy tightness is lifting both traditional producers and transition names. 4. Regulatory divergence is creating concentrated jurisdictional risk. 5. TradFi is encroaching on crypto, but volatility is keeping institutional caution.
Nice. Say a bit more on the Capex theme. Practical signals to follow.
Track announcements from hyperscalers and chip makers, along with data center pledges and corporate power purchase agreements. When you see multiple large Capex commitments, like a $15 billion data center pledge, that tends to presage demand across semiconductors, data center real estate, and utilities.
Got it. Basis spreads and regional grid constraints were mentioned in the article. Can you explain that in simple terms?
Sure. A headline crude price is useful, but regional basis spreads, the difference between local and benchmark prices, determine who actually benefits. Similarly, in power markets, a region with grid congestion can have much higher prices or require more investment than the national average. So watch regional data and pipeline or transmission announcements, not just the headlines.
Short reaction.
Makes sense?
Now for the bigger picture. Risks to watch.
Regulatory and political risk tops the list, especially for media consolidation and cannabis. Then inflation and rates. Tighter oil could keep inflation elevated. Execution risk on integrations like the big REIT deal is real. Sector concentration around AI is a risk if Capex slows. Finally, crypto structural risks can cause spillovers into correlated assets.
So no one-size-fits-all thesis. It's a selective market.
Exactly. Data and filings over the next few weeks, regulatory timelines, hyperscaler quarterly updates, and oil inventory reports will be critical for determining whether selective momentum broadens into a broader upswing.
Before we wrap, a couple of short tactical takeaways for listeners to track. Just headlines and catalysts.
Monitor deal approvals and integration plans for large transactions. Follow AI Capex announcements from hyperscalers and chipmakers. Watch energy spreads and regional grid constraints. Track regulatory calendars for cannabis and media. And read volatility as information, not just noise.
Perfect. Final quick thoughts. Mood of the market after today?
Balanced. Capital flowed into AI, renewables, and scale consolidation, but regulatory and episodic shocks kept a lid on broad exuberance. It felt like a mid-cycle tape, selective upside driven by scale and infrastructure with concentrated risk pockets to watch.
Great summary. If listeners want to follow up or ask questions about anything we covered, where should they go?
Head to stockalpha.ai where you can ask us directly through the Q&A feature and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks, Jessica. And thanks to everyone listening. We'll be back after the next close with more recaps and takeaways. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. See you next time.